Right now, the stock market is officially closed as we look at the numbers on July 16, 2026 at 1:09 p.m. IST. Looking closely at the final figures from the most recent active trading session on July 15, 2026, Super Micro Computer Inc., trading under the ticker symbol SMCI, finished the day at $26.89. This represents a clear decline of 2.75% during standard trading hours, continuing a highly volatile and downward trend that has kept market participants on edge for weeks. When you see a once high-flying technology stock slipping below the $27 mark, it signals that the market is actively processing deep structural questions rather than trading on simple technical momentum. For anyone managing an individual brokerage account or looking at stock screens, this current price level represents a massive reset from the historic peaks seen during the early phases of the hardware build-out. Here is the twist that defies basic market logic and immediately shatters standard investor expectations, creating a massive puzzle for anyone involved in online investing. While the stock price has been carved up, dropping significantly over the past couple of months, the underlying demand for their server infrastructure is reportedly through the roof. Supermicro recently confirmed that they secured a staggering $39 billion in new customer orders over a window of just a few weeks. To put that massive number into proper perspective, that single batch of incoming orders roughly equals the entire revenue the company generated over the previous 12 months combined. Normally, a business announcing that its order book has effectively doubled overnight would see its shares skyrocket, but instead, Wall Street responded by selling off the stock. This massive disconnect between exploding order volume and a collapsing stock price creates a fascinating riddle for anyone trying to navigate technology investments today. If you talk to the average retail trader tracking tech names on a popular Robinhood app or scrolling through standard social updates, the common assumption is simple. The general belief is that Supermicro is a pure, unadulterated proxy for the massive hardware boom, riding the coattails of NVIDIA stock and capturing massive server market share due to its tight engineering relationship with major silicon providers. People expect that as long as modern data centers require massive clusters of graphics chips, this company will effortlessly expand its footprint and enrich its shareholders. But the deeper reality we have to confront is far more complex and significantly less pristine. The reality reveals a company trapped in a difficult cycle of working capital starvation, severe shareholder dilution, and recurring regulatory headaches that have severely damaged institutional trust. It turns out that building ultra-dense liquid-cooled server racks requires an immense amount of upfront cash, and the way management chose to secure that cash has left current stockholders holding a much smaller piece of the corporate pie. To understand why the stock has behaved this way, we have to look closely at the mechanics of their recent $7 billion financing campaign. The company found itself in a position where it had to build out massive amounts of physical inventory to satisfy those incoming $39 billion in orders. Because their operational cash flow was deeply negative, showing a trailing 12-month loss of roughly $6.9 billion in free cash flow, they had no choice but to tap the public capital markets for immediate relief. They structured a massive capital raise that included $1.25 billion in direct common stock sales and $3.75 billion in convertible notes, alongside an aggressive at-the-market equity issuance program scheduled for later down the road. Because investor sentiment was already shaky, they ended up pricing their new shares at $27.75 each, a level that represented a painful discount compared to where the stock was trading just weeks prior. For everyday people checking their Robinhood stock trading portfolios or managing a long-term retirement strategy through Fidelity Investments, this massive supply of new shares acted like an anchor on the stock price. When you look at the recent trading charts on an interactive brokers platform, the technical breakdown becomes very clear. The stock failed to maintain its ground above the critical 100-day simple moving average and broke right through the $30 support zone, drifting all the way down to its current low 20s range. Daily trading volumes have consistently spiked on down days, often exceeding 40 to 50 million shares traded in a single session, which tells us that institutional funds have been actively reducing their exposure. This distribution phase is happening even as rival technology companies show strong operational momentum. If you look at options activity or track how people allocate capital on major investing sites, there is a clear migration of capital toward competitors who boast cleaner balance sheets and more predictable corporate governance. Investors who used to view this stock as an automatic buy are now stepping back, looking for professional investment help to determine if this dip is a structural trap or a genuine value play. The recent quarterly earnings report perfectly captured this internal conflict between top-line growth and real-world execution challenges. On one hand, the firm delivered decent adjusted earnings of 84 cents per share, which actually beat what the consensus analyst estimates were forecasting, and they even managed to tick their gross margins up to 10.1%. On the other hand, the actual revenue figure came in at $10.24 billion, which missed Wall Street expectations by a massive $2 billion. A $2 billion revenue miss during a historic hardware spending boom is a major red flag for analysts. It suggests that despite having an endless line of customers waiting for servers, the company is hitting severe supply chain walls, component shortages, or logistical bottlenecks that prevent them from shipping finished products out the door and recognizing the sales. For anyone practicing self-investing through an individual brokerage account, this mismatch shows that demand is not the problem. The issue lies entirely within management's ability to execute without running out of cash. It is highly educational to observe how different types of market participants are handling this volatility across various online investing platforms. Over on the retail forums, interest remains incredibly high due to the sheer intraday volatility, with short-term traders using Robinhood fractional shares to play the sudden 10% daily swings. Meanwhile, more conservative capital managed through automated wealth systems like Schwab Intelligent Portfolios or a dedicated Fidelity Wealth Management account is largely steering clear or reallocating toward safer large-cap technology holdings like Apple stock or diversified tech baskets. The options chain on the interactive brokers trading platform shows an incredibly high implied volatility rank, indicating that the market is pricing in massive moves surrounding the upcoming earnings cycles. This tells us that the stock has essentially become a battleground where short sellers, momentum traders, and long-term technology believers are constantly knocking heads, making the need for clear investment help more vital than ever. Beyond the balance sheet dilution, there's an ongoing geopolitical and regulatory undercurrent that continues to spook institutional allocators. Reports surfaced regarding investigations in Taiwan involving former or current employees of secondary electronics distributors who were allegedly linked to unauthorized shipments of high-performance server clusters into restricted regions. While management has been quick to clarify to media outlets that the corporation itself is not the target of these foreign regulatory probes and is actively cooperating with international export control officials, the headline risk alone acts as a massive psychological weight. Large asset managers who handle billions through Fidelity brokerage accounts or premium portfolios can't afford to hold companies that carry lingering regulatory question marks. Every time a new headline emerges regarding export compliance or internal controls, it triggers an automated risk mitigation sell program across quantitative hedge funds, suppressing any organic recovery the stock attempts to mount. To properly evaluate if the current market price makes sense, we have to look past the noisy charts and remind ourselves exactly what Supermicro does at its core. The company is essentially the premier architectural mason of the data center world, utilizing what they call data center building block solutions. Instead of designing a single rigid server configuration, they create highly modular individual components, power supplies, motherboards, and chassis that can be mixed, matched, and snapped together with extreme speed. This architectural flexibility allows them to take the latest high-end graphics processors from the NVIDIA stock ecosystem and design a custom optimized server cluster weeks faster than traditional legacy computer manufacturers. Just recently, on July 15,